Hello and welcome to this episode of Your Money with me, Mary Holm. Thanks for taking just a few minutes to listen in while Jessie Mulligan and I talk through some useful ideas about how to make your money work better for you. Just remember though, this is guidance. Final decisions are up to you. Over to Jessie.
Let's talk to Mary Holm. She's in every couple of weeks. Hi, Mary.
Hi, Jessie.
She's our personal finance expert with advice on money. And everything I've learned about money, I've pretty much learned from Mary's columns over the years and from her regular visits to us here at RNZ. And we do a sort of a mix, don't we, of sort of topic ideas and taking questions and letters from the audience. And today we're going to do the latter.
Yes. Yeah, we asked for letters about people's worries about KiwiSaver. We got a good mix of letters and we're going to go through half a dozen or so today.
So Arman says that I'm so new to KiwiSaver. I keep hearing from friends and also on your show from Mary about it, but I really don't know the basic concept of it and how it works, how you, your employer and the government can contribute to it. For a dummy like me, can Mary introduce a website or something so that I can make heads and tails of it? Do you think that's a common problem?
Not at this stage, really. I think, 5 years ago, yes. I mean, KiwiSaver's been around for 10 years. Most people, I think, know the basics now, but, not everybody. And good on Arman for writing this letter and coming back to the very basics. And, in the end, I think the best website is the Sorted website, which is run by the Commission for Financial Capability, partly because it's government funded and therefore it's not put together by a provider. A lot of the KiwiSaver providers do really good education stuff, but it's not, it could be biased a bit towards their products, whereas the Commission's one is straightforward and they do a lot of really good stuff. And if Arman and others want to go straight to their page on KiwiSaver Basics, I made a tiny URL of it so that it was easier. So that's www.tinyurl.com. That's just a way of making URLs shorter. And then you go / and then it's called KiwiSaver Basics. So that's one way. But otherwise, you can just go to the Sorted website and play around on there and you'll find they've got some basic information. When it all boils down to it, though, the very basic idea is that you're saving money and the government is also putting money in as well. And they put in 50 cents for every dollar you put in, up to a maximum of $521 from the government for $1,043 from you. And then your employer, if you're an employee, also puts in 3% of your pay. You're putting in 3% or higher, and they put in 3%. And so what it amounts to, Arman, is that your money, typically if you're an employee, is doubled. By the time you get the government money and the employer money, it's roughly doubled. And so that means if otherwise you were going to save, say, $100,000 for retirement, you're going to have $200,000. So it's as simple as that. It doubles your money if you're an employee. If you're not an employee, it's sort of 1.5 times your money. So it's really worth spending a bit of time finding out about it because you get great dividends from it.
And the idea behind it was so that we got a bit better at saving for retirement, right? So that the government didn't have to bear the burden of all of us turning 65 and saying, hey, where's my money coming from?
Yeah, well, we are getting New Zealand super, of course. We always did, and I reckon we always will. From the government. But I think, yes, there was certainly a feeling that New Zealand is pretty poor at saving for retirement. And so let's try and, in the end, it does take less pressure, mean there's less pressure on the government to give people more money in retirement if most people are happily funding their own. So, yeah, so it's a good program, so do get into it.
Susan just heard you say 3, 4 or 8%. She says, why the big jump from 4 to 8%?
Yes, isn't that interesting? It started out at 4 or 8 from memory, and so they just sort of came up with those numbers, the designers of the scheme, and then they decided to lower the minimum amount because I think quite a few people were saying 4% is too much. So it's down at 3. They added 3% to the mix. I think it's the Retirement Commission who's been suggesting they put in a 6% amount as well, But in fact, if you are putting in 3 or 4% and you'd like to put in more, but not right up to 8%, you can directly send any other contributions you like directly to your provider, not doing it through your employer. And that's a fine thing to do. So you can do that as and when it suits you.
Okay, next one comes from Andrew. That's a question from Andrew who says, Mary, how can we trust the government to not just nick our KiwiSaver funds when they get into deep enough financial trouble? That's a fairly common sort of a worry, isn't it?
It is. And there's no way you or I or the Prime Minister or anybody can guarantee what future governments are going to do because they just say no, change their mind, we've changed our mind. But realistically, it's just not going to happen where the government would make any change that radically made KiwiSaver worse, and certainly not taking your money any more than they would raid your bank account. KiwiSaver is your own money. It's in your account in your name, and the bank could theoretically maybe commandeer everybody's bank accounts and take all that money from everybody. But it's as silly as that, actually, to worry about that. It's just simply not going to happen. I mean, remember, we're a democracy and governments can't do mad things like that and get re-elected.
Yeah. Okay.
Yeah.
So don't worry about it.
No.
Kids and KiwiSaver. Jean says we put money into KiwiSaver for the grandchildren when it started, thinking the money would increase. However, their savings are about the same now as when we started 10 years ago. I'm sure fees have increased exponentially in that time. I remember when they were $2.50 per month flat rate. Now I see many different fees have piled on and many are a percent of the principal. Am I correct in thinking the fee structure has changed? It must be a real cash cow for providers should there be more regulation.
Yeah, no, interesting letter from Jean here. There's a lot in it, and it's absolutely shocking that if she and her husband put some money in for the grandchildren 10 years ago and it's hardly changed, that's pathetic. Before I start addressing some of what she said, though, people might want to grab a pen and paper if they're interested in KiwiSaver for children, because I've got a list of some of the providers who offer special deals for kids and KiwiSaver.
Yes, that's one problem I noticed when I went to start one up for my little girl is you don't have much choice. Well, you didn't back then anyway.
Oh, is that right? I mean, every KiwiSaver provider will take children as members.
I think this was back in when you got the $1,000 kickstart or something. There were only some that would do it anyway.
That doesn't sound right, but
okay.
But
anyway, you don't get that $1,000 anymore.
No, you don't, unfortunately, and that obviously prompted a lot of people to get kids into KiwiSaver, and it was a great idea. But before we get into that, one of the questions Jean asked was whether KiwiSaver fees should be regulated or whether there should be more regulation, and that's a question that does arise a little bit. I'm on the board of the Financial Markets Authority, and we think about that sometimes on the board about what sort of regulation there should be. But there's definitely trends in KiwiSaver fees going down. There's new entrants into KiwiSaver. A sort of notable one was Simplicity 2 or 3 years ago now, who've come in with lower fees, and there are others that charge lower fees. And Juno has now just recently, JUNO, has just started a KiwiSaver scheme, and they've got no fees for children. And but they're not the only ones doing deals for kids. More about that in a sec. But the point is that the market, I think, is taking care of the fact that KiwiSaver fees in some cases are definitely too high. They haven't gone up. Jean's had the impression they've gone up. I don't think anyone's actually raised their fees.
And in fact, there's a sort of a sniff of some more competition,
yes.
maybe pushing downwards on fees lately.
Yeah, no, that's what I think's happening. And so, and that's obviously a better way to do it than for the government to regulate, really. It is for the market, for people. And the way that works is for every listener out there to take notice of their fees. People have got to take note of what fees they're paying on their KiwiSaver and go for the low fees. The way the fees are set up, I'm pretty sure with every single provider this is true. They charge a flat fee. and a percentage fee. So the flat fee is typically between $25 and $40-ish per year in most cases. So it's not a huge amount for most people. But of course, if you've got a kids account and there's just $1,000 in it, or if the kid joined up after the kickstart stopped, they might have only a few $100s in that family has put in for them. And if they're being charged $30 or $40 a year on that, that really does eat into it. And then after that, there's a percentage fee that the provider will charge, which is a percentage of your balance. And so obviously the higher your balance is, the bigger that fee is.
Not a percentage of the return.
No, it's not a percentage of the return, that's right. I mean, some people argue that it should be, but that's a question for another day, because that would get very complicated. When there are losses, does that mean the providers have to pay you rather than you paying them? And there's all kinds of complications come out of that. But given that there's a flat fee and a percentage, it does mean that if you've got a low balance, you'll hit harder, because that flat fee is going to hit you a lot worse than if someone's got, $50,000 in KiwiSaver, then a flat fee of $30 or $40 is nothing. It's irrelevant, really. But in the case of Jean, probably what's happened is the balances are pretty low, but it also sounds to me as though their provider has got high fees. They won't have gone up, I don't think, but they are high. And so I would suggest they move the kids' accounts. It's not hard to move accounts from one provider to another. All you have to do is go to the new provider and ask them to do the moving for you. So you don't have to go back to the old one and say, I don't love you anymore. So just looking at the different providers that do offer deals, as I say, Juno charges no fees for people under 18. And the following, Craig's Investment Partners and Simplicity, which I mentioned earlier, charge no annual fee. They do charge a percentage fee, but given that the children's balances are pretty low, if they're charging a percentage fee with Simplicity, it'll be well under 1%. I'm not quite sure with Craig's, it might be around 1%. It's not a huge fee if the balance is low. So they're still pretty good deals. New Zealand Funds also offers a deal that's slightly complicated, but they offer a slightly better deal for children. Aon gives you a small reduction on your annual fee, but not much. So there are a few providers out there that are doing something, and that will be worth looking into. You might, though, want to consider, if you go with one of those because their fees are low, when the child gets to 18 and the fees go back up, they might want to move again to a different provider. You don't want to be with one solely.
That's what I noticed about, I think it was Juno, who, good for them, are really sort of trying to stir things up at the moment, but they do ramp up as you get older. So I guess the business model for them is get people in young, and then they'll benefit later.
I think what they do is actually charge a higher fee as your balance gets bigger, rather than necessarily as you get older. Although both would happen together probably.
Yes, probably.
But yeah, so you don't have to necessarily stick with these ones once the kid gets to 18 and the deal's no longer there. I mean, they're hoping you will, of course, but you don't have to.
And they're probably right, given how lethargic we all are about this sort of thing.
Yes, exactly.
Okay, Kelly also has a kids-based question. Kelly and Welly. In 2006, I assigned my then 10-year-old son up to KiwiSaver to take advantage of the government's $1,000 kickstart. 12 years on, as a millennial working in a minimum wage job, he is constantly having to opt out of the contributions in order to afford his rent. My question is why, when it was me who signed him up at the age of 10, doesn't he have the right to decide whether he opts out of the scheme altogether? He's tried a number of times and been flatly denied. There must be many others who were signed up by their parents as kids who are in the same position. It doesn't seem fair they can't reverse the, albeit well-meaning, decision made by their parents on their behalf.
And this is a really good question that Kelly's asked. And I remember when KiwiSaver started that I asked the officials, what happens when the kid gets older and says they don't want to be in KiwiSaver? And they were kind of vague about it at the time. And I thought, we'll wait and see what happens.
And now it's happening. Now we're in the first generation of ungrateful children.
Yes. We're saying, hey, what went on here? I'm a wee bit puzzled by the fact that Kelly says her son has to constantly have to opt out of the contributions, because when he gets a job, he will be automatically in KiwiSaver because he's been signed up, but then he just says, I want to go on a contributions holiday, and it can be up to 5 years long, that holiday, and no one should be bothering him again for another 5 years, and then he can just simply renew the holiday. Maybe he's changing jobs a lot, and every time he gets a new job, he's got to explain that to them. But it shouldn't be that hard to explain to his employer, no, I don't want to be contributing, I want to be on a contributions holiday, and just say that once for 5 years. So it shouldn't be that big a deal. But
I saw someone suggesting recently that they might want to look at reducing that holiday. I can't remember where I saw that. It might have been the tax.
The retirement commissioner has been at use, and I agree with her. I think the maximum holiday should be just 1 year. And with the right to renew it, and just renew it each year. So there's no you don't have to do anything other than fill out a little form that says I want to go on holiday. You don't have to prove anything. But I think most people who've gone on contributions holidays have gone on for the full 5 years, and that's not very good because within 5 years often they could have started contributing again, and they really need a nudge to get back into it. But the main point I want to make with Kelly is her son's on the minimum wage, and when you work that's $16.50 an hour, when you work that out, if he's working a 40-hour week, and if he were just putting in 3% of his pay, that's less than $20 a week. So it's not, even with someone on the minimum wage, I mean, if you're really trying to feed a lot of children and all that, maybe that $20 a week really counts. But I would suggest Kelly talks to her son about whether or not he could perhaps spare, it's $19.80 a week would be going in if he's on the minimum wage, whether he could spare that, because I think he'd find he could, and then he is getting in there, building up this habit of saving, and as his pay goes up, this is building up a chunk of money for him to buy a first home with, and it's a real pity if the kids aren't in there doing that. So,
and in theory, for every $20 he puts in, he'll be getting an extra $30 topping it up.
He'll be getting $20 from the employer, and another another 10 from the government for a while through the year. His money will be more than doubled. When I said earlier, employees' money is typically doubled. For people on low wages, it's actually more than double. For people on very high wages, it's less than doubled. Okay. So $20 a week, come on, you can do it, young man. Okay. Yeah.
Is a non-KiwiSaver fund better, asks Carol. I'm considering putting a savings into a non-KiwiSaver investment portfolio. I'm concerned about being locked into rules about when and how much I can withdraw from KiwiSaver. The government can or may change the rules and how we can access our funds, but if I did it in a non-KiwiSaver investment portfolio, I wouldn't be affected. Note that I intend to keep putting in the minimum to get the yearly government top-up to my KiwiSaver. It's just that I can see many private investment funds which look very similar to my existing KiwiSaver portfolio. If I need to take my money out, I can do it whenever I like, and I don't have to wait. Conversely, I can keep adding to it as long as I wish. Is there any point in sticking with a KiwiSaver fund instead of a personal investment fund? And there are, by the way, several funds that my current provider offers to private investors, and the minimum investment is $10,000. It looks like a better option.
Yeah, and that's interesting, by the way. That minimum of $10,000 could get in the way of some people, but obviously it's not a problem for Carol. First of all, I just want to say good on her for continuing to put in enough to keep getting the maximum tax credit. She's saying she's still putting in, and anyone in any situation, I really recommend they keep putting in $1,043 a year, get $521 from the government. Why wouldn't you? But she's saying, what about putting the extra somewhere else? And the obvious advantage of doing that, putting it somewhere else, is the access to the money, as she points out. You can take it out whenever you want to. She actually also says, I can keep adding to it as long as I wish. Well, that's actually true of KiwiSaver as well. So that's not a particular advantage of being out of KiwiSaver. In retirement or at any time in your life, you can always put more money in. The main argument against doing what Carol's suggesting is that the fees tend to be higher on similar non-KiwiSaver funds than on the KiwiSaver ones. So just watch that. Have a look at the fees you're paying, because if they're a fair bit higher, that really does eat into your returns. But other than that, I think it's a good idea to put money in a non-KiwiSaver account as well.
Okay.
Yeah.
I'm sure you've discussed this before, says Rosemary. By the way, if you just tuned in, personal finance expert Mary Holm is answering listener questions about problems with KiwiSaver or potential problems. Because I teach, I unfortunately don't always get to hear your wonderful advice, Mary. I'm a late 50s primary school teacher. I belong to the Teachers' Retirement Savings Scheme, and I'm tracking okay with that, but I wonder if I should join KiwiSaver too. It would mean no employer contribution, as I think that was best kept for the TRSS. Is it still a good idea to join with probably 6 years teaching or full or part-time ahead, and just contributing a basic amount in order to collect the government subsidy? And in your opinion, with a freehold house and the teachers' scheme, would growth investment be the best way to earn a little extra?
Yeah, no, this doesn't apply just to teachers. There are other people around in other, like the state sector retirement savings scheme, so a lot of other government workers. And then there are some people also in private companies that run super schemes who are wondering if they should be in KiwiSaver as well. And typically in these schemes, which, as Rosemary points out, applies in her case, you're not going to get employer contributions to both. She's getting her employer, the government's putting in contributions into her teachers' savings scheme, and they won't put them into KiwiSaver as well. That's a bit of a big ask. But nonetheless, it's a really good idea to get into KiwiSaver as well. Now, there's a key point about this. If Rosemary goes into KiwiSaver in her first year, she's going to have to contribute 3% of her pay to KiwiSaver, as well as contributing to the other super scheme. But look, she can keep doing that forever if she can afford to do it. That's fine. There's nothing wrong with doing that. But she might say, look, I don't really want to contribute that much to both schemes, but just do it for a year, because after a year you can then take the contributions holidays I've been talking about, which can last up to 5 years and be renewed. So at that point, then what she should be doing is getting 1,043 into the KiwiSaver scheme every year in order to get the maximum tax credit. The easy way to do that is to set up an automatic payment into your bank account of either $20 from your bank account to KiwiSaver of either $20 a week or $87 a month will get you there, and it sort of automatically takes care of it. In Rosemary's case, she said she's in her late 50s, so let's say she's got 6 or 7 years through until she gets to 65. So she's got, say, 6 or 7 years worth of $521, which is about $3,500 of government money that she's missing out on otherwise. So it's a really good idea to do it. She's sort of saying, I'm probably 6 years working full or part-time. Now, if she decides to retire before 65, she should still try and get that 1,043 into the KiwiSaver every year to get the 521 coming back. Now, she also asked at the end, didn't she, if she should be in a growth fund.
Yeah, at late 50s with the retirement, she reckons 6 years away.
Yes, so she said, should she be in a growth fund with KiwiSaver or something else? And the answer to that really depends on what fund she's got, her work super scheme, the teachers' retirement savings scheme, what level of risk she's got that money in. If that's in a lower risk one, then she might want to put the KiwiSaver money in a higher risk one and plan to use that KiwiSaver money later in retirement. If you're going into a growth fund, you really want to be doing it with money you plan to spend 10 years or more away. So it depends. If she's in a higher risk one and the teacher's one, she might want to make that a lower risk one to sort of balance it out somehow. Yeah.
That's the end of the letters. A couple of text concerns that have come in. I know that you'll be able to answer, Mary. One concern is that by the time this person reaches retirement in 20 years, the government will be starting to reduce superannuation payments because of KiwiSaver. They'll be looking at your other ability to use, I guess, funds that you've already got and cutting away into your superannuation.
Yes, and, as I said before, we don't know what a future government might do, but I don't think they're going to reduce NZ Super too much because of the fact that there are so many voters in that age group and the children of those people in that age group who don't want to see mum and dad ripped off. And old people vote too, much more than young people. So I don't think Super's going to go down much. Even if it did go down somewhat, though, you still want to be one of the ones that's got bigger savings elsewhere. You don't want to be one of the ones with low savings elsewhere if and when Super goes down.
I think so. They mean like means testing your superannuation
means
on
testing.
your
Okay.
KiwiSaver.
Yeah, so means testing, for those who aren't familiar with that term, is saying, well, we're not going to give super, or we're not going to give as much super to better off people. And in a lot of other countries they do that. Like in Australia, they only give state super to people on lower and not so well off. It's a common thing. Whether they start means testing New Zealand super, it's been praised around the world for not means testing it, actually. I mean, one of the big problems with means testing is people then use family trusts and all kinds of other ways to get around, so they look as though they're poor. They give their money to their kids on the deal that the kids will actually quietly give it back to them. There's all kinds of ways around it, which is one reason the New Zealand government's resisted it. There's no guarantees with future governments, but you can be sure a government's never going to set it up so that people with bigger private savings are going to be worse off or even as badly off as people with smaller private savings, because of the message that would send to young people at the time. Young people at the time would start saying, I'm not going to save if I'm not going to end up better off. And so even if they did means test a bit, they're not going to set it up so that you're worse off if you've saved more.
Okay.
Yeah.
Can I finish the session with a small plug, Mary?
You certainly may.
We've been spending the last few days working on a piece on this proposed tax on capital that the tax working group came up. And just went up on the spin-off website today if people are interested in my learned thoughts on that.
I'd be interested to see.
It's been quite
that
fun.
too.
Don't know if you've made your way through that tax working group interim report yet.
I haven't
It's got
read
some
it
good
all
stuff
yet.
in it.
Yeah,
Really
yes.
interesting stuff.
Yeah.
A really thorough look at the taxes that we have in New Zealand and fairness and what things are overtaxed and what things are undertaxed. And so
Yes.
last time I started chatting on TV actually about taxing capital, I heard from a lot of people who got really, really angry at me. People get quite cross when you talk about something that they feel is their matter of expertise. And so I thought, well, I must be on the right track here if I'm making these sorts of people angry. So I've written quite a lengthy piece which has been fact-checked by economists and tax lawyers to make sure that it's unimpeachable. So you can find that on the spin-off website.
I must look for it. And yes, and I have certainly read some of the report, but not all of it.
Yeah.
I've got a quick question for you, nothing to do with any of this.
Yes.
When you have these 3 songs and people have to get what's in common, has anyone ever got it after only one song?
Yes, I get very cross with them. Happened last week.
Did it?
I had a very, very big prize all set up, and they got it after the first chord of the first song. The first chord of the first song.
My goodness.
I know.
That's incredible.
So you've got to sort of balance the sort of making it hard enough that it lasts for a while, but not making it so hard that people roll their eyes and say, oh, mulligan, what a waste of time. Anyway, no one's got today's yet.
No.
Do they know it's
Very
Christmas?
good.
And don't you forget about me. We'll have another one after 3 o'clock. Thanks, Mary Holm.
Pleasure, Jessie.
When's your book out, by the way?
Late November.
Okay, great. We'll talk about that then.
Yeah.